Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just now to go now to the closing bell, and stocks are rallying here. The Dow surging over 1,000 points as oil slumps. This comes as Iran and the U.S. both seem willing to end this war. Joining me now are Yahoo Finance's Jared Blickery and Jake Conley. Welcome, guys, both to the show. Jared, my friend, I'll start with you. With these equity markets, which are surging, what do you see?
Jaw-dropping moves here. It is the last day of the quarter. It's also the last day of the month. Sometimes you just see mean reversion in these time periods. But let's go to the Wi-Fi Interactive, and you can see there the Dow is up 1,000 points, pretty much at the high of the day here. NASDAQ is up even more, 3.6%. S&P 500 up 2.5%. And I just want to get a year-to-date chart here. You can see the S&P 500 is going to close out probably around 4 or 5% down. That's going to be the worst quarter since September of 2022. That was right before this whole bull market began. But one of the things I want to show right now is a 200-day moving average. We talk about this key technical level quite a bit. Yes, we are still under it, and we're going to see selling potentially anywhere up until about 6,600, 6,700, 6,800. So we're by far not out of the woods just yet. And let me show you what's going on in the sector action. Today, it's very impressive. We're seeing tech up 4%. We haven't seen a day like this in months. For the S&P 500, by the way, and the NASDAQ, we haven't seen a day like this since May of last year. So it's easy to get caught up in the headlines. But remember, we do have potential rebalancing in effect here. That's when you have a big quarter that's down or a big month that's down. Sometimes you see some buying in that very last day, and that could be what's happening here. So this is what's happening for the day. Let me just show you how we're wrapping up the month, because this is a very different picture. And you can see we are far from erasing the damage that's been done here. And you take a look at the worst performing sector, Staples XLP, that's in the lower right there. That's down 9.4%. This is the worst month for Staples and also healthcare since 2018. So classically defensive sectors that you might think would protect you in a drawdown, they have definitely not worked. Why is that potentially the case? That's because they were doing well earlier this year. So everything's contextual. But you can see from what you're looking at right here in the sector action this month, and then I'll move on over to the NASDAQ 100. This is what happened to the NASDAQ 100 in March. Well, this is a very different story from what's happening today. And there you can see all that green here today. Nvidia 5%. So things are not back to normal, but it's a step in the right direction. I just remain a little bit skeptical.
All right, Jake, bringing you here as well. You have seen a flood of headlines today. The most recent one are these signals we're getting that perhaps the leadership in Iran, or some of the leadership in Iran, could be open to kind of negotiating into this war. What do we know about that?
Yeah, that's exactly right. You saw the real headline today, Iran's president coming out and saying, and I'll quote here to the EU Council President Antonio Costa, that Iran, quote, has the necessary will to end this war in exchange for certain guarantees. In state media on Monday, also reporting that the president said that the Middle East must guarantee the security and interests of the Iranian people to end the war. Again, signaling that maybe they are willing to at least talk about ending this. Now, you saw the foreign minister, Abbas Araghchi, coming out today telling Al Jazeera Iran is not negotiating, but they are exchanging messages with the U.S.
When you, Jake, because you're following this story so closely, when you see those headlines, though, like these Iranian leaders are speaking, and you hear about the president could be signaling this, the question then becomes, like, what line of sight do we have whether the president has, how much authority, how much power does that person have? Does he have the support and backing of Khomeini? Does he have the support and backing of the military? Or are we sort of operating in a cloud here? We really don't know.
One of the questions you've heard people ask again and again is, who is the U.S. actually talking with here?
Right, that's what I'm trying to get at.
Right. Yeah. Are they talking with Mohammed Bagher Ghalibaf? Are they talking with Abbas Araghchi? Are they talking with Masoud Pezeshkian, the president? There's a lack of clarity around who exactly is in control, but the president is seen as a pretty respected figure within the regime. The problem that the U.S. is going to run into, anyone trying to negotiate right now, is the delta between what the U.S. wants and what Iran says it requires to end the war. Iran right now has control over the Strait of Hormuz. President Trump can say a lot of things, but ultimately, this is kind of in Iran's pocket of when this ends. Now, what is Iran asking for? Iran is asking for full control of the strait. That's already going to be a no-go for most of the world. They want to rebuild their nuclear and missile program, a no-go for the U.S. They want wartime reparations. They want guarantees no further attacks are going to happen again. All of that's going to be very complicated for the U.S. to agree to, especially when the U.S.'s demands are you reopen the strait and you don't control it, you disable and never rebuild your nuclear program, we do not pay you reparations, and you do not get security guarantees. Those two sides could not be further apart. So for all the talk and all the bullishness in equities today about potential negotiations, potential ends to this conflict, those two sides are still very, very far apart.
So, Jared, back to you, because Jake mentions the bullishness in equities today. Does the move you're seeing here today, does it suggest anything broader to you about investor positioning or investor sentiment? I will say my buddy Peter Bukvar was telling his clients earlier in the week, Bukvar was telling them, he said, when it comes to sentiment, he said, we are ripe for a big rally upon the end of this. And specifically, I know Peter was watching the CNN Fear Greed Index, but what do you make of that?
Yeah, so whenever you have sentiment extremely negative for a period of time, as it has been, that just sets up the potential for a big short covering rally. And that could be also explaining what we're seeing here today, just simple short covering. So positioning, we've seen tons of hedge fund selling. We haven't seen anything like capitulation, but it's been of the order of what we saw in the depths of the pandemic. And so, you know, you give a situation like that, we are ripe for a reversal. I think that's what's happening today. And I can go back to the charts. Let's go to, for instance, what's happening in semiconductors on the Wi-Fi Interactive. This is what's happening today. Again, a bunch of stocks, a bunch of big ones up 5%. Here is for the month of March. And you're not going to see a lot of green there. ARM is up 17, Marvell's up 20%, but for the most part, the big guys are down. Taiwan Semi's down 10, Broadcom down 3%, ASML down 9.5%. So we are far from out of the woods here. Then you take a look at software. It's not as bad, but that's because software took a lot of pain from September of last year through February, so it got a little bit of a reprieve this month. In fact, I remember as soon as the war started, software was one of the best performing sectors that week, and that's simply because it was a short covering rally, and we really haven't seen software do much since then. So, you know, I go to tech because it has been the leader of this AI rally. We're 3.5 years in, and I would love to see this continue, but it's going to take more than a day. It's going to take more than a day that happens to fall on the last day of the quarter in the month.
Jake, I'll end it here with you because Jared was mentioning the moves we see today in the equity market. What about the moves we see in the oil market? What do you make of how those markets have responded and reacted to the headlines we were just chatting about?
Well, you see the exact opposite that you saw in equities in oil. Brent trading down by 2.5%, WTI trading down by 0.7%.
So these are cautious responses.
Right. This is not oil pulling back below 100. This is not oil pulling back below 90. This is not the war is ending trade.
Do you think, in part, that's the oil market's telling you, well, even if this war ended tomorrow, it would take some amount of time to get back to something resembling pre-conflict normal in the Strait?
That's exactly right. Every strategist I talk to tells me the tail of this is now likely to be measured in years. And not only do you have to factor in the damage.
Years. I thought we were talking months.
Years. Not only do you have to factor in the damage that has been done to major energy infrastructure, but you also have to consider the fact that the market is going to bake in a geopolitical risk premium now. If oil's fair value, call it $80, that risk premium might add $5 on top for 6 months to a year and a half to 2 years.
Just to add to that, I mean, you take a look at that risk premium, and it's not just in the oil market. You can see that as an elevated VIX reading. That's going to be with us for some time, and Wall Street is just not as highly leveraged as they used to be. So I think since the pandemic, investors have been conditioned that we see a period of selling, and we're right back at highs within a few days. It's hard to see that quick recovery. I mean, we've seen it before, but it just usually doesn't happen that quickly. So investors who are kind of baptized in the pandemic, there's still some hard lessons to learn out there, and a prolonged correction to bear market, we haven't seen one of those really in a long time.
And also keep in mind, the physical market is still leading oil, right? Paper is down today. Physical barrels in Dubai and Oman on Murban crude are still trading at 160, 170. And a lot of the traders I talk to tell me that futures curve is going to have to come up to meet the physical at some point, because you just cannot have this steep imbalance between where real barrels are trading and where paper crude is trading.
All right, Jake, Jared, great chat. Thank you guys. Appreciate it.
Thank you.
Turning to chip stocks now, Nvidia continuing its investment spree as that company reveals its plans to invest $2 billion in Marvell Technology. Here to decode the AI playbook, let's welcome in now New Street Research Technology Infrastructure Analyst Antoine Chkaiban. Antoine, it is great to see you. Maybe, Antoine, start simple for us, right? Like bring us up to speed. Why is Nvidia doing this partnership and investment in Marvell, Antoine? What is CEO Jensen Huang exactly getting out of this in layman's terms?
Thanks, Josh. Great to be back on the show. So I think, there's a number of reasons here, potential reasons. Of course, if you're Nvidia, you want to weaken your strongest competitors, right? And for Nvidia, the strongest competitors one of them is, of course, Broadcom, who is helping, like big customers like Google and others, like bring to market very specific chips that can compete with its own GPUs. And so, by partnering with a company like Marvell, like they strengthen Marvell's ecosystem. Like they allow, for example, Amazon, who has its own ASICs, designed by Marvell, to integrate them maybe more tightly with its GPUs. And so, of course, that can maybe cast a bit of a shadow on Broadcom. So that's number one. And number two, more generally, like Marvell has a very strong portfolio in a number of areas that are very important for AI infrastructure. In particular, like optics, DSPs, that go in optics, especially for like very high bandwidth or long distance links. And so it makes a lot of sense also for Nvidia, to partner with Marvell from that standpoint.
So as an everyday kind of investor listening to this, Antoine, did you see this headline, read the news from the companies and thought, yes, this is a good deal for both Nvidia and Marvell, a win-win?
No, I think when Nvidia invests in all these companies, what they're also trying to do is they're making sure that they're strengthening their partners to ensure that they have like the capabilities to ramp new products, to strengthen their roadmap with the right kind of pace for Nvidia not to see any bottlenecks anywhere else. There are a lot of bottlenecks these days in the AI supply chain, and I think part of this partnership is about that specifically as well.
It was interesting, you had this chip company, of course, investing in another chip company. Marvell's CEO told CNBC, I don't know if you saw this, Antoine, doesn't view it as a zero-sum game, that what they're doing here, he says, is really growing the TAM, expanding the entire market. Is that how you see it?
Yes, I think the market is going to be very, very large, and there's going to be room for like many of these vendors to grow very strongly. We're talking about like a market that's growing, that already grew from like $200 billion or so last year. It's going to grow to $400 billion this year. That's an incremental $200 billion just in 1 year. Keep in mind that just like six years ago, the entire data center compute silicon TAM was maybe $20 billion. Now these days we're growing $200 billion in a single year. And we're going to keep growing. We have, like a lot of data points from the supply chain. For instance, Taiwan Semi, we know how much capex they're putting into the ground. We know like the capacity of their fabs, and so we know like how many chips, how much incremental spend there's going to be, on these data center chips over the next few years, and there's going to be room for growth for many of these vendors.
Antoine, I want to dig into Nvidia a little bit more with you. Listen, you cover Nvidia, you like Nvidia, I know that, it's a buy, you tell clients. And I'm just curious what you make of the stock action. If you pull back the chart, Antoine, listen, it's up more than 50% over the past 12 months, but it's down nearly 10% this year. And really since basically July of last year, Antoine, it's basically gone nowhere. What is going on here exactly?
I mean, I think, I'm going to start maybe with one observation on that. If you look back in October, in Washington, Jensen, talked about $500 billion of Blackwell and Rubin orders until the end of 26. And 2 weeks ago, that number increased to 1 trillion. And that goes, of course, until the end of 27 now. So if you do the math, that's an incremental $500 billion of bookings in just 4 months. So it's like a $1.3 trillion of run rate and bookings these days that Nvidia, is adding from its customers. And so that's just facts, like there is no way not to negotiate here. And so what I think is happening right now is that the markets needs to wait and see, because these numbers are so large that at this point you need to build a conviction, not just based on what Jensen is saying, but based on how much the economy can afford, that this money is actually going to get spent. And I think that's really what's going to be the catalyst. And I think we're going to probably going to get more visibility from the hyperscalers on what their plans are for next year. The same way we get visibility on what their plans were for this year, early in 2025. That's probably going to help. And of course, just seeing Nvidia beating and raising, because this kind of run rate, that gets us to, from a revenue standpoint, to Nvidia generating close to like $1 trillion of revenues exiting next year. So that's like 25 bucks of EPS maybe. And so that's definitely not sustainable to have a stock trading below 200 on that kind of earnings. So I think just Nvidia beating and raising is also going to be a catalyst.
Antoine, I'll end here kind of just on a broader question. Geopolitical conflict, Antoine, war with Iran, the energy shock. How, if at all, Antoine, do you see this impacting the businesses and demand for the chip names that you cover?
So every time there's like like for example, when we saw like the beginning of the Russia conflict, the conflict with Russia, like we were talking about bottlenecks, in parts of the supply chain with like some specific materials that are required, like to manufacture semiconductors or like in energy, etc. And so when you look, like a few years down the line, I think that the supply chain has adapted, and I think that kind of resiliency is probably going to repeat itself going forward. And everybody sees bottlenecks everywhere in the supply chain, and everybody's working very hard on them. And so maybe it's going to create some impact in the near term, but over the long run, I don't think that's going to be too much of an issue.
Antoine, as always, great to have you on the show. Thank you.
Thanks, Josh.
Coming up, how oil markets are digesting Trump's headlines on ending the war in Iran. Stay tuned to Market Domination. President Trump is reportedly willing to end the war in Iran without reopening the Strait of Hormuz. Let's look at how prediction markets are reacting to all this. Polymarket odds of ship traffic along the maritime passage returning to normal by the end of April currently stands at 19%. Let's now look at the oil markets more widely. Vikas Trivedi, Macquarie Group Global Energy Strategist, joining me now. Vikas, it is great to see you as always. So listen, there are just a flood of headlines today, Vikas. Maybe the most recent one being, okay, perhaps signals, Vikas, that the Iranian leadership, or at least some in the Iranian leadership, may be willing to negotiate an end to this war. What did you make of those headlines, Vikas? And what do you make of how the oil market is responding and reacting to those headlines?
First, on the what the Iranians said or purportedly said, a little bit skeptical. I don't necessarily doubt that they said it, but I don't know if they mean it yet. I think it's a little too early for them to be ready for making a deal. I think, they have to feel like they need a few more things to levelize the playing field. Otherwise, all a negotiation does is puts them right back where they started, but with a lot less capability. And, our view is that wouldn't make sense.
So is the response in the oil market today, Vikas, which is cautious, what is that signaling? Is that telling investors that, listen, even if the war ended tomorrow, that it would be some time before we would return to something resembling, pre-war normal in terms of traffic when the Strait of Hormuz? Is that the signal?
It is the signal. And I think in this case, it wasn't so much what Iran said or didn't say, it was President Trump, sending a message that maybe we, the U.S., would leave the area without Hormuz being reopened. And really on the ground, and you guys were describing this in a previous segment, that doesn't change the situation on the ground. Until Hormuz is open, you have to find all kinds of mitigation to work around it, with strategic reserve releases, East-West pipeline, and so on, refining run cuts. You have to do a lot of drastic things to try to cover that shortage. So even if we leave and the Iranians say, okay, we're going to be okay with that, the Strait has to reopen.
Let's say, Vikas, let's say we do get a negotiated end to this. How long, Vikas, before you would see traffic return to normal in the Strait of Hormuz? I mean, what is the timeline? Because I hear various analysts weigh in, like days, weeks, months. I've heard years. What do you think?
No, it would probably be a couple of weeks before things started to normalize. There's a lot of ships that already have oil ready to go, so you could get those going. And then you have to go through the logistics of, getting some of the storage that's built up to high levels moved onto ships so you can make room for production to grow. And that would take a few more weeks. So, all in, before you could see full normalization, we could see 6 to 8 weeks.
So that's the Strait of Hormuz, Vikas. What about energy infrastructure in that region? How badly damaged has some of it been? How long would that take to repair?
It's unclear. Some of it will be very quick. Some of the damage done by drones, as we've seen in Russia with Ukraine, can be fixed very quickly. Meaning days to a couple of weeks. Other parts of the damage, we're not as clear on what all has happened. If it's a big process unit, that takes like a bespoke project to fix, that could take several months, could take a year. So until the full damage assessment of the Middle East downstream is able to be made, I think it's tough to say. But certainly some part of it will come back fairly quickly because that's the nature of some of the drone strikes.
How does the oil shock, Vikas, spread downstream, fertilizers, et cetera, the kind of domino effects? How are you explaining that to clients?
Yeah, look, some of these will have a longer tail. We funny enough, don't think oil will have a longer tail. We think it can get back to normal. Like I said, within some parts of it, within weeks, some parts will take months, certainly not years. But some of the other, and really it goes to, how big are the markets? How much storage do they have? How fungible and tradable are they and interchangeable? So some of the markets, as you just mentioned, that are not that big and they're more fragile, the logistics chains are fragile, that could take a long time to go back to normal because if you're on the other end waiting for these materials and you're not getting them, you're going to have to figure out how to hedge that against a future event.
Finally, Vickers, I'm just curious, what does this all mean for the American consumer and prices at the pump, Vickers? Like if you negotiate into this war relatively soon, days, weeks, how quickly, Vickers, would prices at the pump get back to $3 a gallon? Would they?
Yeah, we think they would, but maybe a little bit north of that because we do think there will be enough refining damage that could take months and maybe a little bit longer. So even when all the crude oil is available, you may not be able to run enough refining capacity because of the damage, in which case you won't make enough diesel and jet fuel and gasoline. So, we think we'll get back to lower levels, but maybe not where we were pre-war. That may still take an extra several months or maybe more than a year. Just depends on really how long will it take for the global refining system to look and act normal as it was pre-war.
Vickers, as always, great to have you on the show. Thank you, sir.
All right, thank you.
For more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. Well, from corporate plans of remaking the American dream to Americans on the hunt to inject a dose of joy into their everyday lives, let's dig into it all with the stories we're watching. Yahoo Finance's Brooke DePalma join me here to discuss, starting with Jamie Dimon's multi-year push to go after more Main Street customers. So per the Journal, Brooke, Jamie Dimon thinks the American dream is on life support.
Right.
Now, Mr. Dimon, he can tend to be somewhat downbeat. And listen, he runs a big bank. It's his job to think of risks out there. Kind of comes with the gig. But it was sort of a stark warning. And so he has some plans to get after. What do you make of his plans?
Yeah, so some of those plans include lending up to $80 billion in the next 10 years through loans. They're also going to support more community-driven initiatives. I mean, this is a time where we've been discussing a lot. Over the past year, small businesses have been hit certainly not only by tariffs, but just so much uncertainty when it comes to consumer spending. And so now Jamie Dimon sort of stepping in, as he has in the past, as you noted. He sort of always has been like ahead of the curve, trying to think about these big topic issues. And it looks like now he's sort of stepping in to help these small businesses in a big way.
Yeah, it sounds like the details. The bank is committing to adding 3 million new small business customers on top of the 7 million today. Wants to lend them up to $80 billion over the next 10 years through loans and support for community-oriented banks and investment funds. I mean, basically, if you're Jamie Dimon, if the American dream is alive and well and the economy's humming, that's good for your bank too, right? That's
100%. More people keeping savings, more people investing, more of that. I mean, also what's interesting is he did note housing access and affordability. That's something we've been talking about so much, especially with the fear that there was going to be higher interest rates. Now we're talking more of a rate cut, but there was like this heightened fear, like, oh my gosh, are mortgage rates going to get higher again? So this is interesting too, that he's also trying to tap into these other segments that are really impacting Americans' mindset about what exactly they can afford these days.
Yeah, it was interesting because Dimon kind of suggested he's frustrated with government policy. He doesn't really think it's working. So, you know what? JP Morgan's going to step in. Now, can a bank really tackle something as enormous as the American dream? We're going to find out.
We're going to find out for sure.
All right, two, on the topic of the business world, workers seemingly struggling to find a sense of joy in the office, according to a good piece in the Wall Street Journal. So, continuing this sort of kind of a depressing theme we have going here today. This is another good piece in the Journal, how working in America basically has become joyless, Brooke DePalma.
Right.
The small, you got disappearing small perks, the rise of AI, they've stripped work of all the fun. Sounds bleak.
Yeah, on top of that too, they've cut back on just how much they're willing to let employees spend. So we saw within that report as well, the non-essential expenses fell by over 25% in February compared to last year. So they sort of cut back on just how much they could spend on a bottle of wine while out. Little things like that, even outside of the office to take out clients. Just, I feel like these companies, especially in the age of AI, they're just being a lot more, not only productive, we're hearing a lot about productivity, but also just like, maybe not frugal is the right word, but just much more intentional intentional about expenses,
That's a really nice
about
way to put
where
it.
it's
Yeah.
a very friendly
You should
way.
work in corporate comms. They're intentional. Here's what genuinely, I don't think you want kind of like a miserable, disengaged workforce.
Culture still is everything. I feel like
also, in terms of culture, but also that's just like, listen, obviously I'm no HR expert, but that cannot be good for your company's retention, productivity, you know?
Can I be honest, Josh? I feel like in 2019, the culture vibe was so high. Then during the pandemic, they tried to continue it with like Zoom hangouts and things like that. Not even here, just everywhere, all my friends talking. And now I kind of feel like for the first time in 2026, that vibe's kind of coming back. So when I saw this story, I was a bit taken back.
Were you surprised?
I was surprised because
Yeah.
I feel like maybe the joy, maybe like now all those COVID perks are now lingering down. But I feel like 2026, I'm going to take an optimistic take and think that they're coming back just a bit.
The Journal should have spoken to you for like a contrarian take.
I would love to speak. I would love to speak.
I know who is enjoying themselves.
Okay.
American malls, because they're reportedly winning over teens, Brooke De Palma.
I can see
Bloomberg
that.
reporting teens are sick of their phones. They're sick of their phones. What do they want to do? They want to hit the ball. Bloomberg saying the ball is cool again. What's going on there? What's behind this mall comeback?
Okay, so
Did you even buy it?
All right, no, okay, so I guess I'm super optimistic on all these takes today.
Yeah.
But when I speak, frequently every quarter with Macy's CEO Tony Spring, what he always tells me is that this experience economy, this experiential economy, people are really gravitating, especially with all this bah humbug around everybody right now. They're going to the mall to look for maybe a little luxury, a little spice to life, so to say, with all these bah humbug around them. And what we have seen from Placer.ai, from foot traffic, is that people are actually going to the mall more and more. In January, we saw foot traffic up. You can see it right there. Open air malls, so maybe like Tanger outlets as well as indoor malls. People are going there more and more. And it's
You think it's about the product or the experience?
I was going to say it's not about the products, because now guess what? You not only are you going.
For my kid, it's 100% about the product.
Oh, really?
Yeah, it's all about the makeup. And
So they're
ice
going
cream.
around there looking around.
100%.
But experience, that is an experience.
I thought you were going to say, in part, this is theory, how much social media is playing into this. Like,
Well,
because
that's
what I
something what
heard
the article was playing on as well.
The teen is thinking, what better backdrop for your TikTok? You get a little
And that's what the article
mall
was sort of-
content, right? Get that.
You go, and if you walk into these stores now, it's not just like clothes, it's the heart as soon as you enter in. It's the displays, and people are taking more and more photos there because they do want to recreate what they are seeing on social media. But at the same exact time, now you have sort of these mini putt-putt golf, you have theaters, you have movie theaters. Even in the Jersey City Mall, I went once on a Saturday night because I'll admit, I had to make a wedding and I had to get shoes for the wedding. And it was like no other traffic I've ever seen before. And it's all because people were doing, they were doing what people do at malls. They hang out.
Long-term bullish on malls and kind of retail real estate, or do you think still kind of niche for the kids? What do you think?
Okay, I'm bullish on malls, only because I feel like growing up, I had a great experience hanging out with my friends there. We made a whole day out of it. Honestly, like looking back, like I wasn't on my phone the entire time. Now that's different. Now you go to a
the
mall.
I take my kid to is packed.
Yeah, and everyone's
Packed.
probably on their phones though, for the most part.
They actually seem kind of engaged.
Yeah.
They're shopping,
Which is
they're getting
nice to
after it.
see.
I know. Like literally good luck getting a parking spot. That's how packed.
And that's exactly how it is in Jersey City too. Of course, tighter parking, but
Maybe
that's the
maybe
experience.
it could be just Brooke and Josh. It's like a Jersey thing.
Maybe it's the Jersey
That
malls.
that could be totally it. Yeah, absolutely.
gosh.
Thank you, Brooke.
Of
Appreciate
course.
it. Coming up, we call in for tech support with, of course, our very own Dan Howey. Fundrise is pushing back against a short seller position against that company's publicly listed tech innovation fund. Fund went public, remember, in mid-March with the aims of giving investors access to private venture capital across the tech sector. Fund's top holdings include Anthropic, OpenAI, and SpaceX. Fundrise co-founder and CEO Ben Miller joining me now. Ben, great to have you on the show. Maybe to start sort of big picture, Ben, just for viewers who might not be familiar, just explain, Ben, a little bit more about your innovation fund. Like, what are you sort of offering everyday investors, Ben? What's the problem you're solving for?
Yeah, so we created the first public venture fund about 4 years ago. We went to the SEC and created this investment company that allows anyone to invest in venture capital. And then over the course of the last 3.5 years, we've invested in Anthropic, OpenAI, Anduril, Databricks, Canva, basically among the top tech companies in the country. We have had about 100,000 ordinary investors invest in the fund. Over that time period, invested about $500 million. It grew. Our average client return was about 40% a year. And then we listed it about 2.5 weeks ago on New York Stock Exchange. The fund had a meteoric increase from when we listed it, went up a lot. It spiked last week. It's kind of moderated to a little bit more normalized price. And the whole idea is to democratize investing in the best private tech companies. Private tech has been one of the most important sources of American growth, and yet ordinary people, everyday investors, have not been able to access it, especially not in a low-cost regulated wrapper like VCX.
Your point there being that you have these great American companies, Ben, but they're private and they're staying private for longer. Explain that trend to us. Why is that happening?
Well, I mean, what's amazing is over the last 20 years, private companies can now raise all the capital that you need in the private markets. You can raise primary capital. You can raise secondary capital for employees and venture funds to cycle out. So at this point, private markets rival public markets. You no longer need to be public in order to access capital for the company or for the employees. And so since there's no reason to go public anymore, and there's a lot of negatives of being public, a lot of regulations, a lot of drama, a lot of extra work, companies just don't have to go public. So why would they? And so they're not. And so what's happened is over the last 10 years, I would bet you that the top 20 companies built in the last 20 years are all built in the private markets. There may not have been a world-class company built in the public markets, in 20 years. And so as a consequence, American investors are missing out on a really important part of the economy. And that part of the economy is growing very quickly and becoming more and more important over time.
Who is your investor, Ben, in this fund? I'm just curious. Do you have sort of line of sight into the kind of average demo?
Yeah. I mean, our investors are everyday person. The average investment was $5,000. It was 100,000 investors averaging about $5,000 in investment. The average person is in their mid-30s. They're normal, like they work in tech, they work in healthcare. They're just a normal person who previously could never have access to these companies. And so we made it possible to invest in the best companies in the world in a very low cost wrapper. And now I think it's become more and more important at the moment because AI is a transformative technology. And if investors don't have access to this technology as an owner, not just as a consumer, I think it's going to have very significant social effects.
Ben, we mentioned in the intro this criticism from Citron, and listen, Citron speaks, people tend to pay attention, they listen, and it sounds like what they're saying is, your stock surged, they're arguing, and now trading kind of just way above the net asset value. And here's what they posted on March 26 on X. Again, this was March 26. They said, listen, it's trading at 400 plus. Its assets are worth 19. Simple math, they say. You obviously saw that. What was your response to that, Ben?
Well, that was a week ago. The price is now moderated from it was at $5.50. Now it's about $100 a share. So, basically what happens in public markets is that lots of people can go long and go short. It's very, very normal in any stock Typically, there'll be 2 to 10% of short sellers. This stock actually, I think, is only 1 or 2% short sellers, very, very low right now, at least. And so some people like to grab news, and that's basically how they drive their business. But for us, it's not really relevant. It's essentially like when I think about these great AI companies, the rocket companies, these companies are the most important companies emerging out of the private markets today. And if people don't want to invest in them, they don't have to. But I think it's really important that they are able to.
Citron, Ben, they made this direct comparison between you all and Destiny Tech 100. They say it's the same product, and their point is they face the same issue, they say, and investors, in their words, ended up just getting destroyed there. Is that a fair comparison, Ben, between products that Citron is making?
I mean, I don't think it's very. I mean, there's some comparisons because both of us invest in private tech. I think that company had a different portfolio. So you have a different portfolio. We had 100,000 normal investors before we went public. I think those investors have done pretty well, all things considered. They're up over 100%. So to me, I'm not really focused on where something trades in the short term. Like there was a point when Amazon had fallen 98%, and now it's a $2 trillion company. And so over the short term, the market is a voting machine. Over the long term, it's a weighing machine. I think that really, if you're a long-term investor, you're focused on AI, you're focused on deep tech, you're focused on technological change, then that's what we're about. And if you're a trader, I don't know how to speak to traders. I'm not a trader. I'm not a short-term investor.
Ben, great to have you on the show today, sir. We appreciate your time. Thank you.
Thanks.
Coming up, much more market domination. That's still to come. Amazon launching a deal with Delta on satellite internet. Sports broadcasters are speaking out on the cash grab from streaming services, and one company is making its mark in the wearable device arena. To break down all these headlines, we're calling in for tech support with Yahoo Finance's very own Dan Howley. Dan, good to see you. So let's start with a story you wrote, my friend. Amazon announcing it will provide internet service to Delta via its Amazon Leo satellite starting in 2028. What do we need to know?
Yeah, this is part of Amazon's low Earth orbit satellites, LEO. And basically what this will do will be provide high-speed internet. They say the antennas on the planes can get up to a gigabit per second download to these 500 airplanes in Delta's fleet. Now, it won't start until 2028. Big caveat here is Amazon still has to launch a number of satellites. They say more than 200 in space right now, and they have plans to launch several hundred more in the future. But this is really interesting just because, if you're a Delta passenger, you know that their internet is terrible. You're either, you really could barely load websites. So the fact that you're going to finally get high-speed internet is very helpful. Now, obviously, Delta and Amazon, that's not the only game in town. SpaceX and their Starlink is available on other airlines, including United. And so, they have a huge lead when it comes to this space. There's thousands of Starlink satellites, constellations floating around the planet as we speak, providing internet to base stations on the ground and airlines. And so it'll be interesting to see how Amazon is able to compete in the space that's already dominated by one company, but clearly there's an appetite for more competition if Delta is willing to go in with Amazon at this point when they don't have as many satellites as Amazon. And so the reason why you would want to have more satellites, you would see fewer blackouts when it comes to coverage, things along those lines, better overall connectivity and speeds. And so, Amazon's going to have the lead, SpaceX is going to have the lead there, but Amazon has its time to catch up. You have Blue Origin, which Jeff Bezos owns, going up against SpaceX, which Elon Musk owns. The two space companies have been friendly rivals, or just rivals, we'll say. And so this is just another space for them to compete, basically.
How does Amazon make money off this, Dan?
Subscriptions. It's going to be subscriptions from individual customers as well as these big companies. When you sign into something like this, Amazon and Delta say that it'll be free. You already get free internet on a Delta flight if you're a SkyMiles member. That doesn't mean you have to, get a membership or anything. Pay for a membership. You just basically sign up through the app, and then you can, browse the web as you want. I'm a silver medallion, which is basically the lowest of low. I'm in steerage on the Titanic when it comes to SkyMiles, but I still get free Wi-Fi, and so it's nothing to write home about, like I said, right now. But maybe in 2028, I'll be able to stream videos or games, maybe make video calls. Although, if I get on a plane and someone starts making a video call next to me, I'm going for the exit door.
Dan, story number 2. Per Bloomberg, broadcasters telling the FCC that streaming services should not be allowed to put sports games behind paywalls, because basically it sounds like they're saying games are going to those deep-pocketed tech giants that charge subscriptions instead of remaining free for Dan and Josh and the rest of us. What do you make of it?
It's kind of a pot calling the kettle black kind of idea here to a degree. Yes, you do need these different services. By the way, disparate services. It's not like you can just sign up for one and, unless you sign up for, if it's NFL, you can sign up for their service. But, if you don't feel like signing up for another subscription, you have, say, Hulu, well, then you're not going to be able to get the games on Amazon. But, I'm going to throw this out there. I'm a big Mets fan. If I didn't have Hulu, or a regular cable package, I'm not going to get SNY. And by the way, you don't get SNY with just standard cable. You need, an upgraded package. And so, I don't get Mets games unless I pay for that. So there's already this, a barrier to entry when it comes to watching sports on the daily. I think this is, the idea that perhaps if they're available on regular television rather than streaming, then more people will get access to it, and that makes sense to me. But at the same time, like I said, if I want to watch the Mets lose, I got to pay extra for it, no matter where it's on, if it's on, streaming or just over, Time Warner or whatever. So, I mean, it's kind of a 6-to-1, half dozen the other. I feel like for most people, you're not going to be able to watch TV unless you pay up. It's not as though this is, free anymore, unless you're talking about, say, like the Sunday football games, and you can get that on CBS or whatnot. You still need cable, though.
Finally, Dan, Whoop, which offers this high-performance fitness wearable, just raised $575 million at a $10 billion plus valuation. What do you make of that, Dan? What do you think it tells us or suggests broadly about demand for these wearables?
I think that it just tells us that there's people that are out there that are looking for maybe a little bit more from their wearable and want a alternative to Apple's Apple Watch, right? Like there's still, the Apple Watch is a dominant sports fitness tracker smartwatch in the world, right? But Garmin is out there. They have their own fitness trackers. There's Android fitness trackers from the likes of Samsung. It's not just wrist-worn wearables. There's the Aura Ring, which is able to track your health and fitness. And so there's just, I think, an appetite for more of this. I think this is more based on the overall kind of holistic approach to health, which, by the way, Apple is getting into. They offer a number of different capabilities that Whoop offers as well. But I think their sole focus here on health and fitness, rather than being a means to get notifications for, phone calls or perhaps, using Google Maps, things like that on your wrist, that kind of sets it apart and makes it less of a distraction. And so there's probably more people that are interested in that. That's, again, why we're seeing things like Aura really take off. For me, for my money, I'm still going to get the watch. I want to know who's texting me without looking at my phone all the time. I want to be able to pay with stuff quickly on my wrist. And I just like what Apple does with their ecosystem, especially if you use something like Apple Fitness Plus. You're able to link the two, and it's a lot easier. I hate all the exercises on there just because I hate exercise, but whatever. And I do think, though, there is a market for something like this. Now, that doesn't mean it's going to, push Apple Watch out of the way by any stretch of the imagination, but there is certainly a market for products like this.
Dan, when you hear, they had some big names attached to this one, Whoop, that is. LeBron's investing. It looks like Ronaldo's investing. When you hear that, do you think marketing fluff or no? That's a smart strategic decision.
I think it's column A and column B, right? When you have big name sports people getting in on a sports product, it's got to be part PR as well. But hey, look, if they're putting in their money and they're going to get a return, then good for them. You call me when Keith Hernandez starts investing in this, though.
Dan, thank you, buddy. Appreciate it. Coming up, we've got you covered through the closing bell on Wall Street. That's next. Stocks ending the day in rally mode. The Dow closing up over 1,000 points. And our very own Jared Blickery is standing by with the latest. Jared.
Thank you, Josh. 1,124.94. What a finish to the month and the quarter. I would love to say this is how the quarter went, but today has been the exception. And let's take a look at the Dow here. This is the intraday price action closing right at the highs there, so very bullish day. NASDAQ Composite up nearly 4%. Best day in the S&P 500, NASDAQ Composite, and NASDAQ 100 since May 12th of last year. And you can throw the Mag 7 ETF into that as well. So large caps doing well today. You can see the S&P 500 up about 3%. Russell 2000, the small caps up even more. And here's that big surge we saw intraday around those headlines regarding the war. Is the worst over? I think there's a lot to prove here. As I was saying at the top of the last hour, the stocks here, they have been very eager to kind of cover some of these shorts, I think, that have happened during the month. So last day of the month quarter, you tend to see sometimes a big reversal when there's been heavy selling, and that could be accounting for some of this bullish price action that we're seeing. All right, 10-year T-note yield, that is down 3 basis points to 4.31%. Let's take a look at the 30-year as well. That's down 1 basis point to 4.89%. Wanted to show you what's going on with the VIX here. I'm just going to show you a year to date. You can see it is off of its highs, but it keeps staying elevated here. Anything above 20 kind of raises eyebrows, and it tells you that the long-term concerns of institutional money, they are still there. So we're not out of the woods just yet. But let's take a look and see how the large cap sector broke down today. Tech, that is XLK, up 4.25%. Best day in months there. Industrials, number 2 place, and then consumer discretionary. All of those up more than 3%. And then to the downside, what did well this quarter and month? That was energy, but it was in last place today. And so I think that kind of tells you that that's just some mechanical reversals going on right now. I would want to see this strength persist into the new month, and we'll have to see what comes of that. But let me just go give you a picture here of what happened in the month of March. Only energy, as I was just saying, was positive. Consumer staples, defensive sector, that was the worst. It did very well in January and February, but it gave back a lot in March. So that was down 9%. Industrials, healthcare, real estate, consumer discretionary, and materials, all that bottom row down about 6% or more. And then let's take a look at the NASDAQ 100. This is going to be today. So this is a very green bullish picture. You can see Nvidia up 5.5% there. The Mag 7 doing well. Meta up 6 2/3%. But I got to show you the month to date as well. So there's a lot of losses to be clawed back here. One day does not make a trend, but let me just leave it on the Dow. I'll first show you what happened in the month of March, and where we got Chevron up 10.8%. That was the exception. Small gains for Verizon and IBM as well, but we're going to be talking about Nike real soon. I think Nike was the worst performer in March for the Dow. That was down 15%. Home Depot down 13%. Procter & Gamble, Boeing. So industrials and those cyclical trades did poorly. Some of the defensive trades did poorly, like healthcare and staples. So it was a very difficult month to win in unless you happen to be long energy. And I think that's kind of the big takeaway here. Fortunately, we got a new month on deck tomorrow.
All right. Thank you, Jared. Let's take a deeper look now at the markets as Wall Street wraps up trading for the first quarter of this year. Joining me now, we got Andrew Graham, Jackson Square Capital Managing Partner. Andrew, it's good to see you. So let's just start on these markets. Stock market's just ripping today, Andrew. A lot of green on the screen. You had a flood of headlines, including one, perhaps some signals that the Iranian leadership could be open to negotiating an end to this war. Andrew, what'd you make of the headlines? What'd you make of how the equity markets responded to the headlines?
Well, the markets were set up for this. The positioning metrics that we got last Friday were, you had CTAs and other systematic funds that were net short, at least according to estimates, and you had hedge funds that net positioning was in the 11th percentile. So yeah, positioning metrics had markets set up for a rebound, and all you needed was a little bit of good news to get that going. And here's what we have today. And the point, just in the last segment is well taken. This is the end of the quarter, and so equities are, in terms of pension fund rebalancing, are the place to go in rebalancing flow. So a little bit of that flowing through as well today. and that comes off tomorrow. So we have a new day tomorrow. Markets rarely make a V bottom, so we're not necessarily fading the rally, but we would expect lower levels if there's no material improvement in the conflict with Iran.
Well, in terms of the levels you're watching, just look at your notes, Andrew. It looks like you're flagging 61.50 to 61.75. Why watching those levels specifically?
That's just clear pattern support. I'm not a technician. I've been doing this 40 years, and so you pick a few things up, as you go along. And market technicals are one of those things. And yeah, 61.50, 61.75 were the old highs. And so if you get down to those levels, we would expect a rebound, and that's sort of a double bottom kind of look to it as well. So that's what we hope for. But a V bottom's not out of the question. We saw it in April, and so if we got through another day at 65.25, then we'd probably just throw in the towel and say there's not going to be another low, and then this is another V bottom like we had last April. Before we get into some specific names, Andrew, the sectors you recommend, it looks like here, healthcare, I see REITs, I see utilities. So sounding like you want to be defensive. How come? And I guess how come? And also, what would be the signal to you, Andrew? Okay, time to rotate back into growth. Yeah, I mean, they'd probably be pretty quick. I mean, this is really a trade in the defensive group, and you saw bond yields react immediately to the conflict in Iran. They spiked higher on some sort of inflation impulse. That's not inflation. You don't get inflation from an energy price shock. You get energy prices obviously go up, gasoline goes up, food prices go up, but there's demand destruction, and generally speaking, these events tend to lead to a slowdown in growth. And so that's finally being reflected in the bond market. You see bond yields down the last 3 sessions, and the corollary in equity terms is our defensive groups. And for us, it's really pharma is where we want to be, because we have both the sort of the secular growth aspects of some of these pharma names like Johnson & Johnson, Bristol Myers, AbbVie, Merck, and Lilly. And you also have this near-term benefit from the lower yield environment. But after that, I think markets will probably, if you do get some sort of resolution to the conflict, markets will revert back to their, to where they were prior to where the conflict began. Let's end here on some picks, Andrew. Coherent. Now that stock, nice move. It's up about 20% this year. It's up around 240% over the past 12 months. You say that one just keeps moving higher, Andrew. Yeah, I mean, so while this is going on, the conflict is going on, you can't lose sight of other things that are happening in the world. And 2 weeks ago, you had Nvidia's GTC conference, and then you also had the optical conference, OFC. And those happened in the same week. And I thought the takeaways were really about just higher compute going through each server rack, with the new Vera, Vera Rubin and the Rubin Ultra products coming online soon. And that was just, there's just a ton of manufacturing that needs to take place. And all that compute density that's being added to the server racks needs a great deal of interconnect. And eventually that's going to make its way to copper only. Excuse me, not copper only, the fiber optic only. In the meantime, I thought copper came out the winner in the near term. So for maybe the next 2 years, I think copper networking equipment products have a decent runway for this. So that's names like Amphenol and Credo. But as that's going on, sort of the edge of this whole transformation is going to benefit the fiber optic transceiver names, and that's Coherent and Lumentum specifically. And here, Andrew, on Arista, I want your thoughts there, because you like that one, up strongly over the past year. What's the bull case? Well, Arista has just been the leader in switch equipment for such a long time, and at OFC they unveiled their latest product, and the product is a very small form factor. It has optical components embedded in it, actually 8 optical transceivers inside of their XPO product. And so I thought it was very well received from what I understand. I wasn't on the showroom floor, but takeaways were very, very bullish just on the engineering that took place inside of it. It's all liquid cooled and clean liquid cooled. And so I would think they're going to be an industry standard as the market transitions eventually from copper to co-packaged optics. But for the time being, I see that product Arista has as being sort of a market leader over the next 3 to 4 years.
Andrew, appreciate your time and those picks. Thank you.
Thank you, Josh.
Coming up, Nike and PVH earnings are about to drop. Stay with Market Domination Overtime. Breaking out some earnings now. Let's take a look at Nike as that company reports its third quarter results. Looks like Q3 EPS, 35 cents. That's a beat. The estimate was 31 cents. Q3 revenue, 11.28 billion. Street was closer to 11.24 billion. Q3 gross margins, 40.2%. Analysts had penciled in closer to 39.8%. Looking for Greater China, there it is. Greater China earnings before interest and taxes, 467 million. That's a beat. Street was closer to 269.5 million. Just looking at the after hours reaction here, down about 0.4%. Remember, heading into this print, the stock was down about 20% this year, and it was also deep in the red over the past 12 months as well. I think beyond this print, investors are going to have questions just on the call, more insight from CEO Elliott Hill and just the turnaround efforts at work here. How does he think about getting consumers just more excited about the sneakers, the clothing, the sportswear? What's in that product pipeline now and ahead? I would expect questions about tariffs, the impact of the Iran war, gas prices going up. What does that mean for consumers, even on the high end? China business as well. What does he see now? What's working there and in the future? Collaboration with Kim Kardashian's Skims brand, that has also been front and center for investors too. Right now, the stock basically flat right here in the after hours. We'll wait for that conference call. Well, here with more on Nike's latest quarter results and the retail space, let's welcome in now CFRA analyst Zachary Waring. Zach, it's good to see you. So those results just hit. So far in the initial after hours reaction, pretty muted here, Zach, but what do you make of the print?
Yeah, you've got low expectations and, gross margin was a little bit better than expected, but, pretty much in line quarter. And so I think, investors and analysts are really going to be listening for the conference call, see where inventory is, see how Greater China is doing. I know they talked a lot about inventory in Greater China. They were going to have to do a lot of work there in the first 2 quarters of the year, or for them, it's Q3 and Q4. But I think there's going to be a lot on the conference call that we're really going to be paying attention to.
What, Zach, do we know is in this company's product pipeline that you think is going to excite folks?
Yeah, so they have, they've talked about some new products coming down the line that have done well and seen early success. The issue has been their older classic products, right? So Jordan 1, Air Force Ones, the Dunks, which have seen huge declines over the last 18 to 24 months. And I wonder, those really need to stabilize, I think, before you can kind of see a rebound in shares. You can have product newness, and that's great. But your classic franchises that make up a big portion of your overall sales, they really need to at least stabilize, right? They've been in huge declines over the last 18 months.
I'm curious about your thoughts about the Iran war, Zach, and potential impacts and ripple effects for a company like Nike. You get an energy shock, higher gas prices. That can obviously spook consumers, even at the relatively high end.
Yeah, they're not really getting a break, right? So they've had the tariff impacts over the last 9 months, and now they're dealing with this, and they're a very large global company, so they're going to be impacted more than almost anyone else in terms of apparel and footwear, just because of their size. So they haven't really had a break. Obviously, they're in the middle of a turnaround. They're working on a lot of different things, which is why I think you've seen a muted reaction. There's just not much to get excited about. Valuation is pretty full here, honestly. And in terms of the turnaround, even if it's coming and you think they're going to get back to $3 a share, shares aren't that cheap compared to peers. And it's just, where's the growth story now, right? So where's the growth going to come from over the next 3 to 5 years? And where can they get back to a valuation in the mid 20s, which is what they used to have, but they used to have the growth story to back it up.
You mentioned tariffs, Zach. The Supreme Court, of course, recently struck down many of the Trump tariffs. What does that mean for a retailer like Nike?
Yeah, I do think that will, benefit them this year, heading into next year. Just a lower tariff rate. Obviously, there'll still be some tariffs, but I think if there's an overall lower tariff rate, that will benefit the company. I do think a lot of that has been priced in. Gross margins have come down significantly, not only from tariffs, but obviously the decline in a lot of their, gross margins for, individual products for their classic footwear. So I do think there's a lot going on here. And I do think the turnaround story is in effect, but it's just, there's just not a lot to be excited about. Valuation, like I said, is pretty full, even if you think they'll get back to $3 a share in earnings over the next year or two.
Elliott Hill took the job, I think officially took the reins in October 2024. I'm just curious what you make of the job he's done so far, Zach. Does he have the right sort of kind of priorities and strategy in place here, in your opinion?
I do think he is doing the right thing. I do think this is taking a little bit longer than a lot of people and investors thought. I thought, he's been, at the reins now for over a year. And you've seen very little in, turnaround. You've seen some bright spots with some new product launches, but it's just overall, you have seen just a continued decline to earnings, gross margins. Revenues have been stable, but other than that, I think, you're kind of waiting for the actual financial results to improve. And the inventory turnaround story has been going on. And they still think the first half of this year, fiscal year or calendar year. And so I just, it's a little bit slower than I think a lot of people anticipated.
What about, Zach, this company's collaboration with Kim Kardashian and Skims brand? There's been a lot of hot talk about that and headlines. I mean, but bottom line, how excited should investors be about that?
It is exciting, but obviously it's a little bit out of their realm. Nike's not used to big partnerships like this. And I do think that was more of a publicity stunt more, than it's going to drive financial results. Obviously, you're splitting, financial results with another company on those products. So I don't know how much of a boost to gross margins it can be over the long term. I do think, maybe it will help sales, but I do think they've really got to focus on their classic product launches and really turning around, maybe introducing some new products, what they have done, but and really getting revenue growth back on track.
So you have a hold on Nike. I think you got a strong buy on PVH. So that's Tommy Hilfiger, Calvin Klein. It looks like Q4 EPS 382. That's a beat. Street was at 331. Revenue 2.51 billion. Street was closer to 2.44 billion. And just turning ahead, Zach, PVH's Q1 adjusted EPS, the range is 165 to 180. The Street was at 240. The full year adjusted EPS, they're calling it a range between 1180 to 1210. The estimate was close to 1186. What do you make of this print?
Yeah, so that's a different story. Over the last couple of years, PVH has really focused on their two core brands that you mentioned earlier. And they've really done a good job of improving margins and really working on efficiencies in the supply chain. And you've seen earnings per share really improve there. And it's just, the stock has just been beaten down. In terms of valuation, I don't think it gets much lower. It trades almost like a department store at this point. So we think, there's a lot of upside to shares. We think, the consensus estimates for next year, like you said, were almost $12 a share, which is kind of in line, but that's growth. So it's not like the company's not growing its bottom line. And that's kind of our argument with our thesis, right? We really think there's a lot of value in these shares. Even if it just got back to a peer multiple or a little bit below a peer multiple, shares could be a lot higher.
Get you out of here on this, Zach. You did have some news from the company because Tommy Hilfiger, you saw this, signing Travis Kelce as its global brand ambassador. Something investors should get excited about, Zach?
You've seen a lot of this in recent months and years from all these brands, right? So you've seen American Eagle do the Sydney Sweeney thing, and Abercrombie and Fitch has also done with a launch with Travis Kelce as well. So you've seen a lot of this activity to try to get a lot of momentum behind your brands, but it's just unclear how much financial results you'll see or improvement you'll see from these partnerships and brand ambassador deals that they've had. So, I do think that's a positive. He's, a really positive figure right now in the world, obviously dating Taylor Swift, and he's got a lot of momentum behind his own brand. So I think overall it's probably a net positive.
Zach, appreciate your time and that instant analysis. Thank you.
Thanks for having me.
Coming up, ask you for a trend. Stay tuned. Hello and welcome to Asking for a Trend. Well, market volatility spiked in the first quarter of the year, leaving many Americans near retirement feeling uncertain about the path forward. Our next guest recommends a retirement sketchbook to help savers navigate potential unknowns. Bonnie Treichel, Endeavor Retirement founder and Chief Solutions Officer, join me now. Bonnie, it is great to see you. Maybe start here, Bonnie. You know, there could be a lot of viewers watching right now, and maybe a lot of them were actually thinking about retirement, but now they're watching the markets and the headlines and the volatility, and they're thinking, I don't know, maybe I should delay my retirement right now. Seems kind of uncertain, kind of iffy. What's your advice to them?
Well, there's certainly no one size fits all that's going to work for everyone, but I think one of the things that I would say is don't let your emotions take over, don't overreact, go back to your plan. So many of them probably had a plan in place, so go back to your plan and see what you laid out. Now, someone might say, but I don't have a plan, right? I didn't ever put that plan in. So that's not going to work for everyone. But again, don't overreact, don't get too emotional, go back to what was the plan you put in place and start there. If you didn't have a plan, then really you might start to consider talking to a financial advisor and seeing how you can lay out that next step. But number one, don't be over emotional and don't overreact immediately.
Is that the common mistake you would say people in this position make? Like they're getting near retirement, something goes on in the world, I see my retirement account drop. Is the common mistake to get emotional?
I think that's one of the things that I've seen. And if we go back to like 08, 09, for example, you saw that a lot with folks overreacting, an emotional response. I'm going to move everything to a money market account. Well, then guess what happens after that? Sometimes they forget to move it back in and then they miss out on a bunch of the upside that follows. So again, don't be over emotional, don't overreact. You don't want to move everything. That also can get you into a buying high, selling low, that type of mentality. We don't want to do those types of things.
You say retirement is kind of like a sketchbook. What do you mean by that?
Yeah, so you probably don't go to a financial advisor and get an art lesson, right? Well, my co-author and I, in a recent book that we had published, we take this approach of a sketchbook. And what I mean by that is you're used to the numbers, you're used to the spreadsheets when thinking about retirement, but retirement's more than that. And I'll tell you two examples. Number one, it's about really thinking about making yourself the artist, empowering yourself to take what you get from a financial advisor, take those numbers, but also layering on, you have to empower yourself to, if the markets go crazy, there's volatility, life changes happen, divorce, loss of a spouse, something like that. You've got to resketch, you've got to readjust. Life happens, you have to be ready to take control and readjust. So that's the sketching, right? Erase a little, bold a little,
it's a certain
make
flexibility to have.
It's adaptability, flexibility. And then it's the other piece, which is it's about more than the numbers. How many people, I don't know if you have parents, grandparents, things like that, how many people, they get the numbers right, but what are they missing? They're missing the things like community, purpose, recreation, all those other things in retirement that make a big difference.
You also talk about connecting with your future self. Now, what does that mean in like practical terms, and why is that important?
I'm going to ask you a question. Do you do you follow sports?
Sure.
So if you've played sports,
there is no future Josh Lipton though in sports. If that's where you're going.
No, but if you've played sports, right, you think of things or you've been told things like visualize the shot, right? Visualize the basket. I'm sure you've been told that. The same thing applies with retirement and what you visualize. You are more likely, much more likely to save, to achieve what you can visualize. So is it that you want to be the couple on the beach holding hands? Is it that you want to be the person who is working, in their 80s at the charity, whatever it is? We talk about visualization. You can connect more with something that you've actually visualized. And if you have that visualization, if you've put it down, even in stick figures, where are you going to live? Who are you going to be with? Are you going to have a pet? All those things, if you can visualize it, you can achieve it. If you do that, Bonnie,
can I just ask you, are there hard numbers about how that actually impacts saving, investing?
Yeah.
Connecting with the future self? What does that do?
Yeah, you're 40% more likely, you'll save 40% more if
you will
you're
save
able,
40% more.
There is data that supports that. So again, it's about you'll save more, you'll be able to achieve that, much like what you can see with making the basket. You visualize it, you will be able to achieve it.
You also mentioned divorce, and I thought it was interesting. Are there kind of common mistakes people make when they get divorced as it relates to retirement?
Many mistakes, and it can be everything from you forget to update or change your beneficiaries, right? You get divorced, you forget to do things like update your beneficiaries. You forget to readjust or resketch. What is it? It depends on when you get divorced. For example, I got divorced early on and had to entirely start over 401k, all of my savings. A lot of people, there's a concept of having to divide your 401k account, your workplace savings. So all types of things with saving, investing strategy, beneficiaries, lots of things that you might have to resketch or readjust after divorce. Same would apply if you've maybe lost a spouse. And this can go from early saving years to even things like when you're going to take Social Security later on in life.
Final question, Bonnie. Just get a big picture. How well prepared, broadly and generally, are Americans for retirement?
That's a great question, and there's so much data that is controversial on how prepared people are. But I think, savings-wise, we have two camps. We have some people who they've saved plenty, but they're not giving themselves permission to spend, and so that can be a problem. And then we have another generation which they're not saving enough, and we don't have defined benefit plans anymore. And so we've got another camp that they're going to miss out on some of those savings years. So we've got a variety of different data to support over saving and not saving enough. But I think holistically, we need more for that holistic approach that is the softer side, the what are you going to do in retirement and preparing for the emotional, combined with the actual hard dollar math of making sure you have enough to actually get to and through retirement.
Connect with your future self. I like that, Bonnie. That's good. Thank you. Appreciate it.
Thanks for having me on.
Stick around. Much more Ask for a Trend still to come. The auto industry has had a tough start to the year with tariffs, rising gas prices, and an uncertain consumer backdrop posing as headwinds. Joining me now on this is Yahoo Finance senior autos reporter Pras Subramanian. Pras, you caught up with the Mercedes-Benz USA CEO. What do you say?
Yeah, look, today they released, they showed two new cars, the new Mercedes GLS and GLE, two important SUVs for them. The GLE actually kind of like their mid-size, middle kind of segment car, their top selling vehicle, right? So basically he's saying that these cars are important. They're made in America, very important because you can avoid those tariffs. And it's a big deal for them to get those new motors, new styles in there for the U.S. consumer, which incidentally is doing okay for Mercedes.
I was interested whether you got his thoughts on that, Pras, just broadly on the consumer, what he's seeing. Is he seeing any shifts? What's he hearing from dealers?
Well, he actually told me earlier that Mercedes' sales through the first 2 months of the year were up 20% year over year. So that's pretty good when given the fact that we have quite a bit of uncertainty here with regards to tariffs and stuff with geopolitical stuff. People tend to sort of hold back on major purchases when things are not sort of going well in the world, but not for Mercedes. Seem to be potentially a little immune to that. So I would imagine dealers are happy, Mercedes is happy, and they're actually able to sort of try to boost U.S. production, like I mentioned, because tariffs are still a part of the equation. And last year it knocked off $1.2 billion from operating profit. So that's not nothing right there.
Yeah, no, I wanted to ask you about that. Just on tariffs, Pras, whether he sort of elaborate on that, how he's thinking through and navigating that dynamic.
Yeah, when I asked him about that, he said, well, look, we only raised prices 1.2%, right, for customers, and the tariffs are 15%. So they're sort of eating a lot of that, right? That's not exactly great. But from their point of view, they're saying, look, we can absorb that if we're good about costs, we're good about efficiencies. And he thinks that by growing sales, like growing that denominator, you're able to sort of make more and more profit that'll sort of negate that tariff impact there. But it's still there. They're going to deal with it. But it might be the case that they just start building more cars in America and exporting from the U.S.
Switching gears, Pras, you also wrote about Tesla Q1 deliveries. Now you say here they're expected to rebound slightly. What do we need to know there?
Yeah, analysts in a Bloomberg consensus here is 364,000 vehicles, right? So that's for Q1 globally. That's up 9%, which is, sounds good. But a year ago, if you remember, was actually a pretty down year for Tesla, down quarter because of the fact that they had to change over to the new Model Y, which meant a factory shutdown, and they had depressed sales. And then you can also add in the fact that Musk, at the time last year in Q1, was sort of the height of his sort of unpopularity across the globe, right? Because he was sort of really deeply tied to the White House and Doge, right? So you have a really sort of low base. So you're going to see some uptick there, but I think the concern is that it's a weak base, and so the fact of the matter is that it's not up that much from that point of view.
What impact, Pras, do we think in the U.S. at least, the loss of this federal EV tax credit could be having?
It's not just for Tesla, right? It's Tesla plus, GM, Ford, all these guys, even Hyundai, that make and sell a lot of EVs in the U.S. We saw last year when third quarter, that was the last quarter of the EV tax credit to fourth quarter, market share basically almost halved. You went from 10-point-something% market share to 5-point-something, right? So that's not great. But at least if you're Tesla, they still have positive gross margins. They still make money in every car sold. They didn't sell that many, but they still at least made money on the cars that they actually sold.
How has the competitive landscape shifted for Tesla, Pras, over the past 6 months, 12 months? I mean, how much more of a competitive threat is, a BYD?
BYD is a big threat to them, obviously in Asia, where China is just cutthroat. The most cutthroat auto market in the world right now is China, right? We have dealers there that don't make any money, and they're just subsidized by the state, right? In addition to the automakers. But in Europe too, right? BYD's encroaching in that space. You also have Volkswagen with some compelling offerings in the EV space. It's hurting Tesla. In the U.S., they still have maintained almost 50% of the market share, so they're still the big dog when it comes to buying an EV. But you got to look at the fact that the legacy automakers, they may have taken some hits, but they're still offering more competitive products. And Ford, in a couple of years, well, their second-gen EVs, which they claim are better, software derived, and also will make them money when they sell them.
Final question, Pras. We were talking about Tesla Q1 deliveries. How much do Tesla investors even care about those deliveries? I ask only because I've had Tesla shareholders on the show at this desk, and you can't get them to chat about the deliveries. It's robots and robo-taxis.
Yeah, I mean, for a decent subset of the investors of Tesla, they just care about autonomous driving, robotaxis, Optimus, and Josh, even the SpaceX IPO, right? Tesla is levered to that in some sense. They bought XAI. I'm sorry, they invested in XAI, which SpaceX then eventually bought. And it's sort of, they might just, roll with the momentum of the SpaceX IPO this summer. It might help boost Tesla's sort of just the animal spirits of the stock. But back to the robotaxi business, we're seeing a lot of heat there from competitors like Waymo and Uber, and you're not seeing that much on the Tesla side from the fact that they have not expanded their service offerings beyond Austin and the Bay Area yet, and we're still seeing just very few unsupervised cars in the road. So the question is, when do you see a big step change or a big breakthrough there with the robotaxis? And I think that will, if that happens, Josh, I think that'll be really unlock the stock in my opinion, but we'll see.
Praz, thank you, buddy. Appreciate it.
Thank you.
Well, fitness wearable company Whoop raised $575 million in Series G funding at a $10.1 billion valuation. Investors include sports giants like LeBron James and Rory McIlroy. Yahoo Finance executive editor Brian Sozzi sat down with Whoop founder and CEO to talk the company's growth plans.
Well, we've seen really extraordinary growth over the last 12 months for the business. We've essentially grown our bookings by over 100%. Our member base is now 2.5 million members. And it's not just growth in the US, it's all around the world. So Whoop is in 60 markets now around the world. We're seeing lots of pockets of growth. And it's also a time, I think, when health monitoring has never been more popular or more important. There's a huge push around longevity. And as a consequence, we really saw a lot of enthusiasm from investors. And we put this round of financing together. It was led by Collaborative Fund, who we've known for 12 years. They actually initially invested in our seed round. And then we also wanted to bring in really a wide collection of strategic investors. We've got a number of sovereign wealth funds like 2.0 and QIA and Mubadala participating. We've got investors from Australia, Macquarie. We've got investors from the UK, GP Bullhound. We've got a bunch of existing investors following on, IVP and Foundry Group. So it's a really great collection, and I'm particularly excited about our new health investors. Mayo Clinic has participated in this round of financing, obviously one of the great health institutions in the world in terms of research and capability. Abbott participated in the finance, one of the best medical device makers in the world. So we're very excited about this collection of investors, and we think there's a lot of growth in front of us.
I remember when we first met you, I think it was at the start of the pandemic, you'd always come on remotely with us, and I remember talking to you back then on how I viewed Whoop as an AI play, but I'm hearing you now, longevity, health companies. Like, what is your ultimate vision? As I mentioned, I'm a member. I see what you're doing in terms of health. I can upload my health records on here. But what is your ultimate vision going forward for this?
Well, we want to ultimately build the most powerful personal health platform, which is to say that you come to Whoop if you want to understand your health. If you want to improve your health, if you want to understand it, you come to Whoop. And what that takes is, obviously a very powerful sensor and being able to continuously measure the human body. It also takes a lot of other data sets. We recently launched Advanced Labs, which allows you to do blood testing through Whoop. You're going to see us continue to add more and more sensing and capabilities. And then lastly, it is AI, and it's being able to provide insights to our members and alerts to our members that they wouldn't otherwise be able to get. And so this combination of health sensing and big data and AI, we believe is going to pave the future for a very powerful new wave of health monitoring.
What else do you think my Whoop strap will be able to sense?
Well, you don't have to look too much further than cumbersome, antiquated medical equipment. If you go back in time to how the company was started, it was, hey, can we replace an electrocardiogram for measuring heart rate variability? Can we replace a chest strap for measuring heart rate? Can we replace a PSG machine for measuring sleep super accurately? And we've been able to do pretty amazing things in this form factor. Obviously, in the last 12 months, we announced Blood Pressure Insights, which allows you to measure blood pressure non-invasively from your Whoop. And you're going to see us continue to invest in new capabilities like that in the coming year.
What do you get asked from the likes of a LeBron James, a Cristiano Ronaldo? Because I viewed your early work with athletes as helping drive awareness for this product. Like, how else are they trying to improve what they do?
Well, we're very grateful to have LeBron James as an investor in this financing, Cristiano Ronaldo, Rory McIlroy, Virgil van Dijk, Matthew Vanderpool. The list really goes on. And so it's been extraordinary to get to partner with these athletes. And they always give us great feedback on the bands and the materials and where they can wear it throughout their body. And I think ultimately Whoop wants to ground health monitoring in an aspirational place. If you look at medical technology historically, it's been a very stigmatized space, which is to say that if you wore a medical device, people would ask you, what's wrong? That's like the opposite of inspiring or aspirational. And so we're proud that we've built a health monitor that's worn by the world's best athletes and highest performers because it creates this aspirational halo for health monitoring. And it makes it something that's not only a good thing to do, but it's an aspirational thing to do.
Is the next step for Whoop an IPO? This is the final tranche of private capital, and then you will now set the tone for going public?
Yeah, it's our expectation this is the last private round of financing that we'll do. I mean, the business is now operating cash flow positive and did in 2025. And so ultimately this $575 million, it really strengthens our balance sheet, and it gives us a lot of control over our destiny from here. We've announced that we're going to be hiring 600 people this year. So
a tech company hiring.
That's right. We have a big commitment to human talent. We believe in human talent.
Take that, AI.
I think humans plus AI beat AI every day of the week, at least for now. And so we're making a big commitment to growing our talent base and our team and investing in careers. And I think in the long run, there's just such a big opportunity in the space. I mean, the healthcare space is so broken. Health monitoring is getting so exciting. What AI is allowing you to do with all this health data is so powerful. So it's just a great moment for the company.
A couple fun ones, because my entire gym class knew you were coming in, and they had questions for you. One, first up, will the Whoop strap ever come with a screen that just tells the time? That's it. That's all they want.
No comment on its watch-like capabilities.
Okay, fair enough. Number two, what about earrings? There seems to be a lot of interest now. You look at the Apple AirBuds. Is that a category you would have interest in getting into?
I mean, look, we're always evaluating sensing from every location on the body. We're looking at a lot of different capabilities beyond even what's I think traditionally thought of as health sensing. We're looking at new capabilities that aren't in the market that are, I would say, more experimental. So the whole space at large, we're constantly looking at how can we push it forwards.
Last one for me. I work out actually a terrifying amount each week. Why isn't my age score going down on the Whoop? What am I doing wrong? Am I not getting enough sleep? Like, what's the hack here?
Well, it might be you're not getting enough sleep. You might be overtraining a little bit, Brian. You got that mindset that you can just go.
Yeah.
It may be that you need to improve your VO2 max.
I'm trying. It's gone down. It's gone down with all these workouts.
Okay, so that's problematic. If you're exercising a lot and your VO2 max is decreasing, we might want to relook at that workout program. We might need to have a call with your trainer. Get the guys from the gym on the phone, figure out what's going on.
Yeah. It's been a joy to see how much you've taken this platform. Look forward to that big day for y'all and big day for you on the capital raise. We'll talk to you soon.
Thank you, Brian.
All right, appreciate it.
Stick around. Much more Ask for a Trend still to come. Time now for to watch Wednesday, April 1st. On the earnings front, Conagra Brands, Lamb Weston, Cal-Maine Foods, and Tilray Brands all gearing up to report their latest quarterly results. Companies are expected to shed some light into the state of the consumer. The latest survey from the Conference Board showing consumer confidence rising, but still showing concerns of higher prices. In addition to earnings, we'll also get fresh U.S. retail sales data. Economists expecting February sales to climb compared to the previous month. Advanced monthly sales forecast to rise 0.5% and jump 0.3% when excluding autos. Also on the economic front, ADP will release its employment report. U.S. private employment expected to add 40,000 jobs in March, lower than the 63,000 jobs added in February. And lastly, tech giant Apple is celebrating its 50th anniversary. Company celebrating this milestone as Wall Street remains focused on the future of the iPhone maker and its next category-defining product. That's a wrap on today's show. Thanks for watching.